Hello, and welcome back to Tax and Financial Matters, the channel where we discuss various topics related to tax and financial matters. Today we'll be discussing participation exemption, a key concept in tax efficiency. Don't forget to hit the like button and subscribe to our channel for more informative videos like this one. Let's get started. First, let's understand what participation exemption is. In a nutshell, participation exemption is a tax rule that exempts the dividends and capital gains received by a parent company from its subsidiary from being taxed. This rule aims to prevent double taxation, as the subsidiary has already paid taxes on its profits in its home country. Now, why is participation exemption important? Well, it offers several benefits. Tax efficiency: by avoiding double taxation, companies can retain more profits and reinvest in growth. By avoiding double taxation, companies can retain more of their profits. This means they have more resources to reinvest in business expansion, research and development, or other growth opportunities. Higher retained earnings can also lead to increased shareholder value and more attractive investment opportunities for potential investors. Additionally, tax efficiency can improve cash flow, allowing companies to better manage their financial obligations and maintain financial stability. Encourages international investment: with reduced tax burdens, companies can expand globally with more ease. Reduced tax burdens make it more cost-effective for companies to engage in cross-border investments and business ventures. This fosters global trade and economic growth. Participation exemption also promotes the exchange of skills, technology, and resources between countries, contributing to global innovation and development. Companies can diversify their operations and markets, reducing risks associated with dependence on a single economy, and increasing their overall resilience. Simplifies tax compliance: companies can save time and resources by not having to deal with complex tax regulations. By reducing the number of tax obligations for companies with international subsidiaries, participation exemption streamlines the tax compliance process, saving time and resources. A simplified tax compliance helps companies avoid costly mistakes and potential penalties that may arise from misunderstandings or misinterpretations of complex tax regulations. A less cumbersome tax compliance process can enable companies to focus more on their core business activities, improving overall productivity and efficiency. To qualify for participation exemption, certain conditions must be met. While these conditions may vary by jurisdiction, some common requirements include: the parent company must hold a minimum percentage of shares in the subsidiary. The parent company must hold the shares for a specific period. The subsidiary must be tax resident in a country that has a tax treaty with the parent company's country. Let's look at an example to illustrate the concept of participation exemption. Suppose Company A, based in the US, owns 80% of Company B, based in Germany. Company B generates a profit of $1 million and pays a 25% corporate tax, resulting in $750,000 after-tax profit. Company B then distributes this amount as dividends to Company A. Without participation exemption, Company A would also have to pay taxes on these dividends, resulting in double taxation. However, with participation exemption, Company A is exempt from paying taxes on the dividends received from Company B. While participation exemption is a great tool for tax efficiency, it's essential to be aware of possible limitations and anti-abuse rules. Some countries may have stricter requirements, such as limiting the types of income that qualify for exemption, requiring substance, i.e., genuine business activity, in the subsidiary, denying exemption if the subsidiary is involved in tax avoidance schemes. So, how can companies maximize the benefits of participation exemption? Here are a few tips. Understand the specific requirements in the relevant countries. Maintain proper documentation to prove eligibility. Seek professional advice from tax experts. To sum it up, participation exemption is a valuable tax concept that helps companies avoid double taxation, encourages international investment, and simplifies tax compliance. By understanding the requirements and limitations in each jurisdiction, companies can maximize their tax efficiency and drive business growth. That's all for today's episode on participation exemption. If you found this video informative, please give it a thumbs up and subscribe to our channel for more content on tax and financial matters. Until next time, stay informed and take care.